Hey, welcome back to our channel, and in this video we are going to talk about mortgage insurance premiums and how you could have the right down payment structure which could ultimately save you tens of thousands of dollars in mortgage insurance premiums, and at the same time save a lot of money or save a lot of money in your insurance premiums if you were to switch lenders either at renewal or if you want to break your mortgage and go to a different lender as well. Now, mortgage insurance premiums are charged when you place a down payment of less than 20% when you're buying a home in Canada. In Canada, there are three major mortgage insurers: CMHC, Canada Guarantee, and Sagen. Now, mortgage default insurance is paid by you, me, the client, whoever is purchasing a home when you're placing a down payment of less than 20%. Now, keep in mind this mortgage insurance premium amount isn't paid out of pocket. It actually gets added to the mortgage amount. So for example, let's just say you're buying a $500,000 property and you place a down payment of 10%, which is $50,000. That means your mortgage amount is $450,000. Then the mortgage insurance premium actually gets tacked on to the $450,000. And then both of those numbers combined become your total mortgage amount, the amount that you owe. And that's how much your mortgage payment, monthly, weekly, bi-weekly, is actually based on. So it doesn't get paid out of pocket. Now, the purpose of mortgage insurance, it's called mortgage default insurance, is if someone stops paying their mortgage, the lender can go to the insurer and actually recoup their funds and receive their mortgage amount back. So this actually protects the lender, even though the borrower is paying for the cost. Now, when it comes to obtaining a mortgage approval, there are three insurers, and it actually matters which lender uses which insurer, because not all lenders use all three insurers. For example, you may have a lender that actually uses only two insurers, and your file actually may get declined by that insurer, and now the lender will also decline your file because they don't work with that third insurer. So now you might be thinking you have no options, but you actually do, because there are lenders out there that may use the third insurer, and that might help you get approved. And when I'm talking about being declined, there are various reasons. And for example, let's just say it isn't a borrower concern, it's a property concern. We see that in many, many files. So in that case, the third insurer might do it. So it matters which lender is working with which insurer, and it matters for how the file is sent in and who the file is sent into, to which lender and why. And it's always a good idea to call the insurers upfront, and many mortgage brokers can do that. Now, we're actually going to use different scenarios or numbers to explain how decreasing or increasing your down payment can put a lot of money back into your pocket or save you tens of thousands of dollars. So for example, let's say decreasing your down payment. You might be buying a property for $500,000 and the minimum down payment is 5%, which is $25,000. However, you may think to yourself, wait a minute, I actually want to put my down payment to $35,000, $10,000 more, because I want my mortgage payment to go down and I want my mortgage insurance premium to go down. Now keep in mind, making a $10,000 payment, an extra down payment, doesn't have a massive impact to your monthly mortgage payment. It actually only goes down very, very slightly, almost minimal. But the biggest factor is if you actually increase your down payment to $35,000, your mortgage insurance premium only goes down from $19,000 to $18,600. So basically, you're putting a down payment of $10,000 more, and you're only saving $400 in mortgage insurance premium costs. That is very, very minimal. If you're buying a property, you're better off having $10,000 in your bank account. The biggest reason is you need it for a rainy day. You might be a first-time buyer and you might be a little bit nervous. You might be emptying out your bank account. That $10,000 can be huge for helping you sleep at night, knowing that if an expense comes up in your life or something to do with your property, you have extra money available. Because if you don't, what will you do? The only other option is seek a gift from immediate family or anyone, friends or family, or potentially obtain a line of credit from a bank, and the interest rates on an unsecured line of credit might be 9 or 10%, or potentially borrow money from your credit card, which might be 20+%. So it's very good to have an extra $10,000 in your bank account if you're only paying $400 more. Also, you might need that money to maybe purchase a vehicle so you could get to and from work. Or you might be investing those funds and you have a great chance or a better chance to earn a greater rate of return. So the minimal cost is almost $400 and you're going to save, keep an extra $10,000 in your bank account. In this next example, we're going to discuss or explain how increasing your down payment can help you save a ton of money in mortgage insurance premiums. So for example, let's say you're buying a $500,000 property and your down payment right now that you want to place is 9%, which is $45,000. Based on that, your mortgage insurance premium is about $18,200. Now, if you were to simply bump up your down payment by 1%, which is an extra $5,000, again, this scenario is based on if you have the money available. If you don't, then it might be a better idea to keep that money in your bank account. Again, always run a cost analysis, but in this scenario, an extra 1% is $5,000. That means you're going to bump your down payment up to 10%, which is $50,000. This is actually going to help your mortgage insurance premium go down by just over $4,000. So you're basically putting a down payment, an extra down payment of $5,000, and you're going to save just over $4,000 in mortgage insurance premiums. That's huge, and that's only on a $500,000 property. Imagine if you're buying at a higher price point. In that case, it's very beneficial for you to put $5,000 extra down because you're actually increasing the equity in your home and you're saving just over $4,000 in mortgage insurance premiums. So that scenario there is based on you increasing your down payment. Now, as you can see based on this video, there's a lot of differences in regards to mortgage insurance premiums. And the reason for the differences are mortgage insurance premiums change based on the increments that you place as a down payment. So for example, if you place a down payment of 10%, your mortgage insurance premium percentage actually goes down versus you putting a down payment of 5%. And the same goes for placing a down payment of 15% versus 10%. That's why it's critical to have the right down payment structure in any situation to make sure you're either keeping your bank account full or paying the least amount of money in mortgage insurance premiums, because as you can see, they can be very, very expensive. Now, keep in mind when it comes to mortgage insurance premium and porting your mortgage over, let's just say you want to leave your current lender and you want to port your mortgage over to a new lender, you could actually port your mortgage insurance over too. This is huge. We've heard of many scenarios where borrowers actually paid two sets of mortgage insurance premiums. They paid number one when they first bought their property, and then number two when they actually transferred their mortgage over. So imagine you paying, let's say, $15,000 in mortgage insurance premiums and paying $15,000 again. That's $30,000 gone. And that's actually gone out of your hard-earned money, your equity, and your employment income. So huge mistake we've seen many, many times. And keep in mind when you're switching lenders and your mortgage is staying the same, insured, you have to actually port your mortgage over and not have to pay another set of mortgage insurance premiums. Now, if you are moving and you are selling your home and you need a little bit more money, however, your mortgage is still insured, you could actually pay a top-up premium. So again, you don't need to pay two sets of premiums again. You paid your premium the first time. Now you will pay a top-up premium based on the new mortgage amount. And again, your purchase price as well. But this could save you tens of thousands of dollars in both scenarios. And I want everyone to know that please do not pay two sets of mortgage insurance premiums because it can be very, very costly. Thanks for tuning in. I hope this video was super helpful in helping you realize that mortgage insurance premium costs are very high, but you could actually save a lot of money. And don't forget to subscribe, like, and share, and see you at our next video.